Don't wait.
Joining us in the Trocaire College Live Line this morning, Michael Angelucci from Level Financial Advisors. We're talking about, well, the Fed rate cut and what is happening on Wall Street. Michael, thanks for joining us. The Dow yesterday posting its 10th straight day of losses, marked the worst downward market streak since an 11-day slide back in 1974. Well, that doesn't sound good. What's going on over there?
Well, I think what's happening is the market is adjusting for future interest rate projections, and that became evidently clear yesterday with Powell's remarks after the Fed lowered short-term rates by 0.25%. And the key issues with what he said were, one, he was saying there's more uncertainty around inflation, and that the Fed was now projected to only lower interest rates a couple times next year. Most people thought it would be 4 or 5 times, and that they don't see inflation coming down for another couple of years beyond what they had initially anticipated. And one of the things he said is that he used the term uncertainty, that rates had been lowered 1% to this point. We're in what's called a recalibration phase, and when you're in the recalibration phase, you move more slowly. The other thing I would add around all this is this all led to talk on this idea of what is the neutral rate? What is I call it the Goldilocks interest rate. That's the short-term Fed funds rate that is not too hot or not too cold. If the interest rate is too low, then we could have inflation reaccelerating. If it's too high, we could run into a recession. And for up until this point, people thought that interest rate was closer to 2.5%. Now it seems a lot of people at the Fed think it's going to be over 3%. So that results in recalibration of investment values across the board.
Ooh, so you shouldn't open your 401k or take a look at it this morning, right?
Not today.
What about the Santa Claus rally, right? Don't we usually have that in December?
Well, that's what we're hoping for. I remember, I think it was 2000. Now I'm aging. It's 2018. Things were terrible on the 23rd. I can't remember what the market went down, and then for seemingly no reason at all, the day after Christmas, it rebounded again. So we'll see that the futures are already up today. And the other thing I emphasize is the U.S. stock market is up 22% year to date. It's up over 78% over the last 5 years. These are wonderful returns. These are above average returns. We can always expect to give back a little bit from time to time because markets don't go up in a straight line. It's a jagged line. I like to say it's a yo-yo going up a hill.
So, hey, I can kind of picture that in my head when you look at some of those charts. Well, this is, you mentioned kind of adjusting for the future. So the Fed comes out with this, rate cut, but what we saw on the markets, not so much reacting to the Fed's decision now, but what they said about the future. And I think a lot of people are wondering, well, is the Fed here kind of guessing? Do they tell you exactly what they're going to do? Maybe only a couple of rate cuts in 2025, but how likely is that to change?
It will change based on economic circumstances, and that is one of the things with this neutral rate of interest is nobody really knows what it is, right? And so the Fed has always looked at data. There's some talk today or last night because some people on the Fed were estimate in Powell's terms. They were making estimates of economic effects of policy. So some people are looking at, what could the Trump policies mean for inflation? And generally, the worry is that deportation and tariffs and lower taxes may lead to higher inflation. So there's talk of that being built in to some of these rates. But to your main point, it's these future rates that have affected the markets and knowing that interest rates may stay higher for longer. That's why I mentioned the neutral rate. That would really mean that the short-term interest rates, which all asset values are based off of, is going to remain higher. So if I'll explain this as succinctly as I can. So if you have a stock that's worth $100 and it's making $10 and short-term interest rates are 4%, and you want to maintain that 6% differential, well, if short-term rates stay higher, let's say you thought that they were going to go to 2, but now they're only going to go to 3, the only way you can maintain that differential is if your stock value goes down so you can maintain the same yield. I know that gets a little complicated and wonky, but that's essentially what's happening. People want to maintain a differential on what they're earning in real cash on stocks versus a safe interest rate. And this safe interest rate going forward is affecting the markets.
All right, that does make sense. We're about a month away from a new administration in Washington, and it seems to me that business is bullish on a Trump administration. Is that fading a little bit or not, in your opinion?
That's a great point. That's exactly where my mind was going, because up until this point, the talk was traders on Wall Street were discounting I guess, how far Trump would push tariffs and deportation. And now that the Fed may be saying, well, we're starting to look at this, and some of the things you've been reading and hearing is that Trump is not going to come off the tariffs. There was an article in the Wall Street Journal last week that said, business people are trying to talk to his advisors, and everyone's saying, nope, he's not coming off of this. So the Fed, I can't speak for what they're thinking, but it looks like some of that is coming into place. And maybe the reality is that he's going to push on the accelerator as hard as he has said he's going to, and that some of this ideal that investors had that he would not is the bloom is coming off that rose, maybe.
Well, a lot to kind of sort through, and we thank you for helping us out with that. Michael Angelucci, Level Financial Advisors, joining us live here on WBEN.